Welcome to our mid-year update, which we've titled Tug of War. Now, the year started pretty much as we had expected, at least from an economic perspective. Global growth is undoubtedly on a downward trajectory, and inflation has been even more modest than we ourselves had expected. But one thing that has changed is around trade. The situation between China and the US has become more fraught as the issues have become more complicated, particularly around intellectual property rights and the embargoes that have been placed on technology companies. Now, while there may be some breakthroughs in terms of the trade and the tariff element, we think these other issues, particularly around technology, are much deeper rooted, and there's unlikely to be any great breakthrough, we think, before the end of this year. And that will create uncertainty from a business investment perspective, and I think will subdue business confidence as well. Now, one thing that has been quite profound since the start of the year has been the shift in terms of central bank policies. Back in December, the Fed was predicting that they would move interest rates up by 3 times in 2019. But early in January, they said they were going to be patient and were on pause. And that allowed many other central banks in India and New Zealand, from Australia to Malaysia, to actually cut rates. And we think there'll be more cuts ahead. Indeed, our own view is that the Fed will cut rates in July and probably again in September. And this is leading to investors to feel that there is now a liquidity-driven market once more. While the policy shifts are important to give some kind of support to the economic activity, from an investor's perspective, they see this as liquidity lifting all assets. And indeed, the start of this year has been quite remarkable in terms of the financial asset appreciation we've seen. From government bonds, where we now have about $13 trillion of fixed income assets with a negative yield, to credit, where spreads have tightened, and of course equities, which have boomed over the last 6 months. We're in this world where, again, it seems that investors are continuing to chase yield. Now, where do we go from here? Well, as I said, we think policy will be cut. Although economic growth will slow, we think this will enough to keep investors engaged. And at least for the time being, we see further upside in asset prices. Although once they realize that policy has been cut for a reason, namely that growth is slowing, inflation is very benign, and this will impact corporate profitability, we think we're likely to see greater volatility in these assets as we get in towards the end of the year. Remember, as always, you can read the full report on zurich.com/MSME.